Hi, welcome to Julius Baer's Market Outlook for the third quarter of 2019. Nearly all of the major financial asset classes saw good returns in the first 4 months of the year.
But markets don't usually go up in a straight line, and after such a great start, they were looking for excuses. They found one when relations between the United States and China took a sudden turn for the worse. If we take a step back, we can see that stock market corrections are normal. In the past 10 years, there were 23 times the S&P 500 index went down 5% or more, and the average of those 23 times was a drop of 10%. But remember, even including those 23 times when the S&P fell by that much, it still returned almost 300% over the past 10 years.
As much as relations between the world's two largest economies are important, there are other things going on too. The US economy is robust. Europe's economy is surprisingly beating expectations, and most emerging economies are doing just fine. We expect the world economy to grow by 3.1% this year, a perfectly respectable number. We think, at least for this year, financial market corrections should be viewed as entry points rather than the end of the bull market. And going into the second half, we suggest investors have exposure to companies whose fortunes are sensitive to the ups and downs of the business cycle. That's because we think that in a world with decent economic growth, but only modest cost pressures, companies' profits are going to keep on expanding.
Another place where we like stocks is in emerging markets. Their sudden sell-off in May has made them inexpensive again. Inflation is not a problem for them this year, and of all the stock markets in the world, they are the most sensitive to a rising US dollar. So they've struggled in recent years with the strong dollar. But our economists foresee a weaker dollar in the second half of this year, which would be helpful for emerging market stocks. We also like high-yielding emerging market hard currency bonds. As the search for yield continues, these bonds should continue to do well.
We also think that with a dovish Federal Reserve and low interest rates in the United States, capital will continue to move into U.S. high-yield bonds. Trade fiction doesn't change the fundamental strength of the U.S. high-yield bond market, where we see default rates falling further. But you never know, the world is a funny place. Things can change at short notice, either for the better or for the worse. One thing we can and do foresee is a significant growth slowdown in the economy of the United States next year, and very possibly a modest recession in 2021.
To protect portfolios in the event of a collision, we suggest some exposure in convertible bonds. They give investors the security of cashing out at a set value like a bond, or converting to equity with high returns if the company is doing well. In an environment of good growth but low interest rates, convertible bonds can stabilize portfolio returns.
If investors find the swings that are part and parcel of investing in equity markets too much trouble, they can also consider adding equity long-short strategies to their portfolio. These strategies help protect from losses if the market falls.
Hedging strategies are helpful in diversifying portfolio returns, and multi-asset funds are suitable for changing market environments. When a certain segment of a portfolio underperforms, their losses are mitigated by other asset classes that perform well. To conclude, investors shouldn't worry about the ups and downs of markets in the short term. Keeping calm and staying invested are essential to wealth creation over the long term.